Welcome everyone to our discussion on how to reduce taxes and ESOP capital gains. I'm Dave Govan. I'm an advisor and operating partner with Quantel. I've also had employee stock options in the past from Dell, Hitachi, VeriSign, Oracle. I find this topic to be very valuable. I think you will too. I'd love to turn it over to Shyam for a quick intro.
Yeah, thank you, Dave. Thanks a lot for everyone who has taken some time to attend this webinar. My name is Shyam Sreenivasan. I'm the founder and CEO of Quantel. We are a SEC registered investment advisor. We focus on building AI-driven investment strategies designed to bring institutional grade portfolio management to pretty much all investors. It doesn't have to be a high net worth or institutional investor. We also offer this for advisors. Our approach is a bit different. We combine quantitative research, real-time market signals, and continuous portfolio optimization to help clients not just grow their wealth, but also do so more in a more tax-efficient manner and a risk-aware manner. So we have to always be conscious of like what's the return worth after the taxes are factored in. So before Quantel, starting Quantel, I've spent 2 decades or over 2 decades in Wall Street as a senior executive in a Wall Street firm, and where I consistently saw that there was a huge gap between what sophisticated strategies were doing for high net worth individuals or institutional investors, and what was not available or easily accessible for everyday investors or even to many advisors. So Quantel was built to bridge that gap. Today's session is focused on a very practical and often underutilized lever, which is tax loss harvesting, and how it can meaningfully improve after-tax returns when done correctly. So let's get started. Thank you, Dave. Yeah.
Thank you, Shyam. That's a very impressive background. Tax loss harvesting conjures up a lot of images in people's minds. What is it exactly in simple terms?
Okay, so tax loss harvesting is a strategy where, when you have an array of investments, there is always going to be a bunch of investments which is not really profitable, right? Or at least on paper, you have negative returns. How do you realize losses in those investments that you've got negative returns, or you have losses to be specific? So that can reduce your tax liability without changing your overall investment exposure. So when you think of S&P has got, let's say last year S&P had 17% return, the real positive returns would have been 35% plus, right? Last year that was the case. And the negative losses or negative returns was 17%. And hence when you do 35 minus 17, it's about 17 point some percent return. So if you factor that the negative returns and say, okay, can this actually save on my taxes for this year? That's what tax loss harvesting is about, right? Being smart about understanding where the losses are and can you take those losses and realize it smartly so that can reduce your tax liability for the end of the year.
So in layperson's terms, if I have a large quantity of employee stock options from, let's say, a large tech company, Microsoft or Salesforce or wherever, what does that mean to me? Like, what is it? How's it relevant?
Okay, so I'm sharing a screen. Hopefully you can see it, right? This is a typical quandary that a client faces, right? You have been an employee of a large company like Microsoft. Over the last 10, 15 years, you've accumulated quite a number of shares, but you didn't really bother to sell those shares at different time periods. Maybe you sold here and there for some personal investments, etc. But the more you accumulate a stock of a company over the years, naturally there's going to be an appreciation of the value of the stock, and your cost basis becomes very, very minuscule compared to the current cost basis of the stock. Right? Imagine that Microsoft is currently selling at $200. The actual acquisition price that you have is only $20. Yes. Now, if you were to try to sell that stock, $180 is your gain on that stock. Great. Microsoft gave you a great number of returns, and pretty much every company does that. So if you really have a long career like I did in Wall Street, you would have quite a number of shares that you have amassed over a period of time. But when you sell, a good chunk of that is going to be the value of the stock is going to be the capital gains. Now, if you were to part 20% of that capital gains, now that's a huge tax bill that you would have to pay end of the year, right? So how do you smartly reduce is all about tax loss harvesting. The couple of other reason why this is valuable, right? Tax loss harvesting. If you have a concentrated risk on a big company that you work for, one, you have an exposure to the company because that's your job, right? If the company is
Right.
not doing well, your job is at risk. So that is part of your portfolio in a sense. Job is part of the portfolio. That's a risk. But if you have a good chunk of your wealth in your company stock and the company for some reason during a lean phase is not doing well, every company goes through that phase. Microsoft is down 30% for the year to date in the last 3 months alone, right? It will come back for sure, but there are these phases which will take away the value of the stock, and that kind of concentrated risk in your portfolio is ideally to be avoided. There are so many other investment opportunities out there, and how do you mitigate the concentration risk which one would have if they have ESOPs or even a concentrated position that they have accumulated over a period of time? It doesn't need to be just ESOPs. ESOP is one aspect of employee stock ownership. It could be ESPP, it could be or employee stock purchase plan, it could be your own accumulation of stock over a period of time. So all these different scenarios come in the picture of tax loss harvesting, is like why it is relevant to de-risk your personal wealth from a single stock or single sector exposure.
So when I'm sitting on a large gain and I have capital gains tax exposure, and so tax loss harvesting helps me reduce that. That's what you're
That's
saying.
exactly right. Tax loss harvesting is about how to reduce your taxes now so that you can make whatever that you would have otherwise paid taxes is going to work for you. It's similar in concept for 401k, right? You
Right.
don't pay the taxes now so that that amount of tax that you would eventually have to pay is actually being invested in the market. So even at an average rate of 10% return, now the tax that you would have paid otherwise is actually working for you. Let's say you sold $200,000 worth of like Microsoft stock for some personal reasons, right? Now, 20%, let's say that, $150,000 is the capital gains on that one, which is a typical scenario.
Right.
Now, 20% of 150 is $30,000. Now, that $30,000, instead of writing a check to IRS, you say, no, I'm going to do tax loss harvesting. I'm going to save on the taxes for this year. I'm going to smartly do so that I can invest that money elsewhere. At some point, you really have to pay the taxes because it's more about tax deferral, not tax avoidance. And it's 100% legal. There's nothing illegal about it. It's basically saying I have losses elsewhere that's going to be used to reduce my gains in my other areas. And these gains need not be just from an investment in ESOP or whatnot. It could be from your personal investment. It could be you bought a house, you sold a house, there is a capital gains there. So any and every capital gains that's going to result in taxes can be mitigated or reduced using tax loss harvesting.
Makes sense. So we started talking about this, but like what type of gains can it offset essentially, and where can you get the most value? Like, I sell some of this stock that I have as ESOP, and then you're gonna, or someone like yourself is gonna spread it around. Is that the deal? And some of that is going to be gains and some is going to be lost, but overall my tax position is going to be reduced.
Yeah, so the whole idea here is that instead of investing, let's say you have a Microsoft stock, let's go with that same example, right? You've
Right.
got significant amount of gains that you want to like de-risk your position from Microsoft, right? And it's applicable to any and every stock. It doesn't have to be just one stock.
Mhm.
But what we do is invest that amount that we want to start as principal in a broad array of individual stocks. That's our approach, right? There are different kinds of approaches depending on the risk appetite here,
Yes.
which we talk about. But our approach is to be able to invest in a broad array of stocks that our systematic process identifies.
Mhm.
Now, as we are investing in these stocks, clearly there are going to be ups and downs in the market. There is a volatility there in the market that you can benefit from in this particular scenario. A particular stock is dropping, let's say, a 5% value in a month's time. That's a good opportunity for you to say, okay, instead of like sweating at 5% drop of that particular stock, you say, okay, I'm going to take the losses that I have on paper, realize it to make it a real loss, take that money and invest in something equivalent, similar in return of that particular stock, right? There are other alternatives there. If it's Microsoft is one stock that you're selling, you would buy a Google, right? If it is a CRM or Salesforce,
Right.
You'd be buying some other equivalent CRM tool that's there, or it's a software company that's out there, like Atlassian, for example, right? So there are lots of different alternatives that you would have to map out for each and every one of your investments. The key thing here is timing. So as the market goes through these churn, it creates these opportunities. Just in the last 3 months, market has been extremely volatile. That if somebody had a $200,000 principal for tax loss harvesting, by now they would have accumulated at least $50,000 in tax loss harvesting. That's a 25% value that they would have gotten because of the extra volatility that's there in the market. So these are very important to just be, timing the market and not let go of the opportunity that's there. Some tax loss harvesting will do end of the year tax loss harvesting just on December 31. They would be looking at what is the unrealized losses there and just realize it on December 31. That just loses a lot of opportunity that along the way that you would get. So it's very important to maximize the benefit that the market is providing as opportunity. You just do an active trading, and that's what Quantel helps our customers do in making it very efficient. See, one thing is about tax loss harvesting. That doesn't mean that you want to accumulate just the losses. You want to gain the returns in a comparable manner to whatever benchmark that we choose. If it's an aggressive portfolio, it would be S&P 500. If it's moderate, it would be something like a 60-40 blend. But if it's an aggressive portfolio, I want to get the returns of S&P 500 no matter what, while at the same time, I'm saving on my taxes for this year in terms of my tax liability. So that's an extra alpha that's built in the strategy. And that's how the whole process works.
Makes perfect sense.
There are easy way of doing tax loss harvesting, which you can gain about, say, 3% if you just wait till end of the year. But let's say that a particular stock goes down and comes back within the year, you've lost that opportunity, right? So let's say Microsoft is down 27% right now, but it may pull back 27% between now and end of the year. So that drop that was there temporarily is gone. And so if you wait till end of the year, you're not going to see as many opportunities. And that's just a pattern, right? The more active you are, the more you can actually leverage from tax loss harvesting. So the best yardstick, I would say, is if somebody has got $100,000 of capital, just for example, and usually we see our clients having $1 million plus in their company stocks. But if you say, I just have 100K as an example, just for easy numbers, typically we can get about 1.5 to 2% of the portfolio value as harvesting for each month. If it's a volatile market, you could even go up to 3 to 4% per month, right? We just take the opportunity. One thing that people have to understand is when we sell, we cannot buy the same stock for 30 days. That's called wash sale rule. If they bought it without knowing the rule, then the entire loss that they had cannot be used for harvesting, or it won't be considered as a loss for tax reasons. So that a lot of people don't realize it, and they say, okay, fine, I'll just realize the loss. 15 days later, they just go buy the same stock again. That's just not good. You have to wait for 30 full days. And those are the kind of thing that could trip an average, a person who doesn't have the exposure to it. But the larger point is that you just need the time to do the research, because when I sell a stock, I need to buy a similar stock for us to be able to keep up with the market returns. I want to get the same return or even better. If I have to do that, I cannot keep the cash as cash. I need to invest somewhere, but not the stock I just sold, right? So it involves quite a bit of time. And that's where the use of automation and AI and all those things really come in the picture. And that's what Quantel is really good at. What we have done for our own strategies, like investing, even without tax loss harvesting, we have a lot of strategies that we put for retirement account and joint account and trust account, etc. Our goal is to be able to maximize the opportunities that the market provides. And without the use of technology, you cannot unravel all the opportunities out there. And we use a lot of technology in a systematic manner, which was out of reach for a regular investor. It was always available for high net worth or institutional investors. We are trying to democratize that across the board for all our customers.
Makes perfect sense. And does the system and the approach help me, like, sort of be aware of the harvesting thresholds that I need to worry about, and my risk appetite and all of that?
Yeah, so we do all the work. So Dave, so if you're a customer, you say, okay, hey, Shyam, I have this Microsoft stock. I have $500,000 I've accumulated over the last 10 years. And here is my portfolio. Okay, so we start managing it from there. So in a sense, you really watch us do. You've got complete access or full transparency of what we do because it's your separately managed account on which we operate. Your money is not moved elsewhere. It's against your own account. We today operate with two custodians, large custodians, trusted custodians, Interactive Broker, and Charles Schwab. So your account will be in those two custodians, and we would put that through an algo, and we manage it day in and day out for you on your behalf. So you don't have
So
to
you're
do
not
anything at
touching
all.
my money. It's sitting in Charles Schwab or wherever.
Correct. We are operating your money, but not moving your money. Your money
Got it.
stays with you and no one can move it elsewhere. But we are doing the buys and sells on your behalf every day using our algos. And you get complete transparency of what is being done every single day.
Makes sense. How about like risk appetites? And we have this
So we have
where,
right. So we have two different kinds of risk appetite for particularly for this tax loss harvesting. One is an aggressive risk appetite because we want to achieve a 25% harvesting using the 2% formula that I said. It could go to 30% or 35% depending on the market. So that is one where, let's say you have a portfolio of 100K, we just invest the 100K. We won't take any margin amount or anything like that. We don't lever your portfolio. The other approach is to use a leverage. So if you invest 100K, we would take 150K using a $50,000 margin, and then we invest $150,000 to accelerate your tax loss harvesting. So it's basically using leverage, right? So because the brokerage account gives you the ability to borrow against your stocks that you have. So because you have a collateral of stocks, we take the 100, make it 150, and then we actually make it, instead of giving 25% tax loss harvesting or 20% tax loss harvesting, we could even go to 30% tax loss harvesting because we use the leverage. But with that comes with higher risk is equal to higher reward, right? So, or oppositely, higher reward equal to higher risk. So we would take extra amount of risk in the very aggressive case, and we won't apply it on every single investor. It all depends on the investor's appetite.
Thank you. What's a simple way for someone to begin tax loss harvesting? It's like the easiest way to start doing it.
So the easiest way is to first identify the stock that they have, look at the tax lots that they have. And many people don't realize that when they have these company stock, the recent issuance of those company stock may not even have a capital gain. They may be sitting on a huge amount of money that could just be sold, diversify elsewhere without even a single penny of tax implication, right? That's first is identifying what are the current tax lots on the gains or the stock that you want to tax loss harvest, right? The second is to be able to like partition a portion of the portfolio. You don't do everything in one go. If I have $1 million of Microsoft, I'm not going to sell $1 million in one go. It takes enormous amount of planning and time to do it in chunks, right? So we take a portion of the portfolio that is tax optimizable, and then we then work with identifying a basket of stocks. And these are what our program does that, right? Our systematic approach does. So a bunch of stocks that we ourselves do a lot of research on, and let's say it's got about 50 different stocks there. We can actually do even 100 stocks. But within that 100 stock, there is a variation of like some stocks doing well. We keep the winners and we look at the losers. We don't get out too soon. There's a threshold there. So if you get out on a particular loss, let's say I've got like a 1% loss in a stock, that's not good enough for me. I need to wait for it to accumulate enough loss so that I can actually take a meaningful, capital loss erasing with that loss, right? So that kind of logic needs to be built in.
So you're
When I
monitoring.
sell it, I have to buy another equivalent stock for us to
Right.
be able to keep up with the returns of the benchmark that we want to beat.
So you know the goal I'm trying to accomplish from a tax loss harvesting perspective, and your system's monitoring the ideal time to hold, then sell the loser, and then redirect for a winner. And the net result is I have a reduction in my overall tax basis.
That's right. Yeah. So the goal is to reduce your tax, and that is a meaningful, measurable kind of like return, right? So there is a question I see here in Q&A. Please do shoot out your question as we go, and it's a very relevant question here. What's your minimum investment threshold for Quantel services, and what is your percent for the portfolio management? So Quantel starts investment in a regular investment at $100,000 minimum, right? So if you just put your IRA account, it's minimum of $100,000. We charge a 1% fee on accounts which is less than $1 million. But if it's more than 1.1 million, actually, that is because of some SEC rule that we need to comply with. If you have an account which is more than $1.1 million, we give you the option to make it a performance driven, right? If we perform, we get extra return. But if we don't, we just stick with a lower reduced management fee, which is 0.5%. Instead of 1%, we charge a 0.5%. And then the other part is only based on the performance that we achieve. If we achieve a certain threshold or certain benchmark on the tax loss harvesting, we take a percent of the gain that we give delivered to the client. Similarly, if we achieve a certain performance, which is basically beating the benchmark, we take a percentage of excess return over the benchmark. So we don't just say, okay, if S&P got 10% and we got 10%, there is nothing excess. So we don't charge a performance fee. But if we get 15% where S&P got 10%, then we take a portion of the excess return, which is fair, which is a reward for the performance that we achieve. So we cannot do that on any account less than $1 million. But if it's about $1.1 million, then we actually give you that option to choose a performance-based fee or a fixed fee.
Great. How much does timing matter? And when do you recommend someone should start? You mentioned timing earlier.
It should start as soon as possible in the year. So the tax year typically is ending on December 31, right? So the maximum benefit is for somebody who is going to start in January with a certain goal to achieve by the end of the year. If somebody starts in November for a tax year, see, obviously you don't have enough time for that year to achieve. So you can only get like say 2% of your principal as tax loss harvesting. So it's not enough, right? So the sooner they start, the better it would be for tax loss harvesting. But I would say that if you had a gain this year, you can only use the gain up to this year. I cannot use the losses from next year to offset the gains of this year.
Right.
But if I have gains of this year, I can offset the losses from previous years that I've not used in tax. I mean, we just came fresh out of April 15 tax deadline, right? We are all fresh with our memory of how much of losses we can use, etc. So the loss accumulate, without any time deadline. You can till the time that you use up all the accumulated losses, you can use it, right? Okay. But if I have gains this year from, let's say, a sale of a property, I have to use the losses up to this year, up to December 31. So the sooner you start in the year, the better it would be from a tax loss harvesting point of view. But this is a continuous process. What one would not realize is like, even in your regular day-to-day trading, even if you don't have any loss, you're very successful, still the market gives you enough opportunity to claim $3,000 worth of capital loss. That could be offset against your AGI on your tax code, right? $3,000, if you reduce all your income, that's so much more saving for you on the taxes that you have to pay, 20%, 30%, whatever the tax bracket, right? Yeah. So the tax loss harvesting is not just specific to ESOP, but it's more applicable to ESOP from a risk concentration point of view, that one would have to think of, do I want to depend on my entire wealth or a good chunk of my wealth on this one stock? What if that stock goes down the drain and you lose the entire thing, right? So that's what we try to de-risk it.
So we have another question coming in, Shyam, if you could just. So the question is, how does Quantel AI tech differ from robo-managed accounts at like Fidelity or Schwab, for example?
Yeah, so typically robo-managed accounts are more passive in their investment style. So what I mentioned to you about from a risk appetite point of view, a typical robo is a 60-40 kind of mix is what they typically have. So naturally, when you have a moderate or less than moderate kind of portfolio, then the opportunity that it presents for tax loss harvesting or even higher return is much lesser. Right, a typical robo gives about 8% return. You look at Betterment, Wealthfront. There are lots of examples that you can look where they publish their returns. A 60-40 mix, even Fidelity. If you look at your IRA account, there are going to be some years where the 401k can do well. But if it's not actively managed, if it's a mutual fund which is passive, the opportunity for higher return is so much lesser. It's more stable because you don't look at your portfolio. You don't have to look at your portfolio every day, but that just means that it's not really given the treatment that it deserves as market opportunity is provided, market opportunity is in front of you. So that is the key difference between how much of tax loss harvesting you can do with a passive robo advisory based tax loss harvesting versus an active individual stock based tax loss harvesting. So we do
Thank
the
you.
latter, individual tax based tax loss harvesting, individual stock based tax loss harvesting, and we take a very systematic approach in doing it. That's the other difference. I would say Robo is also systematic, but they do it at a much higher level than what we are.
Thank you.
Yeah.
Excellent. Thank you everyone for attending. We appreciate it. Thank you, Shyam, for sharing that insight. It was excellent.
Awesome. Thank you very much. Thank you everyone for joining.
Bye.
Yeah.